Yes, we've seen a swing over the past several sessions from a little more risk off to a little more risk on. But when you look big picture, it seems as though there still is quite a high appetite for risk in this environment. What do you think is driving that?
I think that's right. I think we're still fundamentally in a kind of buy the dip environment. Fundamentals are strong. It's very hard to see. Maybe a couple of issues I'll come on to as potential risk, but it's hard to see a kind of big internal catalyst in terms of the economic fundamentals, earnings, other kinds of fundamentals. I think we were due a correction like this. It sort of began a few weeks ago. We saw some EM assets starting to sell off a bit, then into high yield, and now it's been kind of the last few days, equity markets, particularly in Europe. I think the common characteristic is those are a lot of assets that had been doing extremely well. I think we were due some profit taking, and I'm not surprised to see a bounce back. I don't think it's a kind of fundamental change of regime.
Rupert, you mentioned those potential risks. What are they? Yeah,
so I think the two things that I think could have contributed to this that could be a little longer lasting are, first of all, quantitative tightening. So we are now, moving into a phase where the liquidity is going to be less plentiful in terms of net purchases by central banks. If you look at kind of G20 balance sheets as a whole, I think that's, some of the market moves over the last week or two where you see kind of all assets selling off together speak to maybe kind of some kind of liquidity issue. I think that's something we need to monitor closely. I wouldn't expect yet that to become kind of critical because, of course, you've still got the ECB, you've still got the Bank of Japan. And the second one is China, where I think momentum might be coming off a bit.